The central bank is a highly important financial institution for the functioning of a country's economy. It is responsible for regulating and controlling the monetary and financial system, ensuring stability and the smooth operation of the economic system as a whole. The role of the central bank encompasses various functions and responsibilities that are essential for promoting sustainable economic development and financial stability. Among the key functions of the central bank are the control of monetary policy, maintenance of financial stability, and regulation of the banking system. The control of monetary policy is one of the most important functions of the central bank. This means that it has the power to influence the money supply in the economy by adjusting the amount of currency in circulation. The central bank utilizes instruments and mechanisms to control the monetary base, interest rates, and credit supply, with the aim of regulating economic activity and maintaining price stability. Monetary policy is one of the primary tools used by the central bank to control the economy. Through monetary policy, the central bank seeks to influence the money supply and the cost of credit, thereby affecting interest rates and inflation. When the central bank aims to stimulate the economy and increase economic activity, it can adopt an expansionary monetary policy. In this case, the central bank increases the money supply in the market, lowers interest rates, and facilitates access to credit. This stimulates consumption and investment, driving economic growth. On the other hand, when the central bank seeks to control inflation and ensure price stability, it can adopt a contractionary monetary policy. In this case, the central bank reduces the money supply, raises interest rates, and makes credit more expensive. This discourages consumption and investment, controlling demand and avoiding inflationary pressures. The central bank employs various instruments to implement monetary policy. These include open market operations, discount rate policy, reserve requirements, and open market transactions. Open market operations involve the buying and selling of government securities by the central bank. When the central bank buys securities in the market, it injects money into the economy, increasing the money supply. This has the effect of reducing interest rates, stimulating consumption and investment. Conversely, when the central bank sells securities, it withdraws money from the economy, reducing the money supply and raising interest rates, which can slow down economic activity and control inflation. The discount rate is a mechanism by which the central bank lends money to commercial banks. Banks can resort to the discount rate when they need additional liquidity. By setting the discount rate, the central bank influences short-term interest rates and the availability of credit in the economy. Reserve requirements are reserves that commercial banks are obligated to hold with the central bank. These reserves serve to ensure the safety and soundness of the banking system by ensuring that banks have sufficient resources to fulfill their obligations to depositors. The central bank can adjust reserve requirements to control credit supply and bank liquidity. Open market transactions refer to the buying and selling of government securities in the secondary market. Through these transactions, the central bank seeks to influence the money supply and interest rates in the market. By buying securities, the central bank injects money into the economy, while selling securities removes money from circulation. Another essential function of the central bank is the regulation and supervision of the financial system. The central bank establishes rules and norms that must be followed by financial institutions, aiming to ensure the stability and safety of the system. Financial supervision involves the continuous analysis and monitoring of financial institutions to identify risks, assess their soundness, and ensure compliance with regulations. The central bank conducts inspections, requires regular reports, and imposes capital and liquidity requirements to ensure the financial health of institutions. Furthermore, the central bank is also responsible for regulating the entry and exit of financial institutions in the market, granting licenses, establishing governance and control criteria, and overseeing the activities of these institutions. The regulation and supervision of the financial system aim to prevent financial crises, protect depositors and investors, promote transparency and integrity in the financial market, and ensure the financial stability of the country. Financial stability is one of the primary responsibilities of the central bank. It works to prevent and manage financial crises, which can have significant effects on the economy and people's lives. The central bank seeks to identify risks and vulnerabilities in the financial system, adopting measures to mitigate them and ensure the solidity of financial institutions. One of the ways the central bank promotes financial stability is through the prudential supervision of financial institutions. It constantly monitors the financial health of these institutions, assesses their risks, and takes corrective measures when necessary. Additionally, the central bank may adopt macroprudential policies, such as imposing stricter capital requirements, to strengthen the resilience of the financial system as a whole. Another important form of depositor protection is deposit insurance. Many countries have deposit insurance schemes managed by the central bank, which ensure that depositors are reimbursed in case of a financial institution's failure. This guarantee helps maintain confidence in the banking system and prevents bank runs during times of instability. The independence of the central bank is crucial for the effective performance of its functions. An independent central bank has greater autonomy to make decisions on monetary policy and financial supervision without direct political interference. This is important because it allows the central bank to act in an impartial manner based on technical analysis, rather than short-term political objectives. However, while independence is desirable, the central bank still maintains a close relationship with the executive branch and the government as a whole. The central bank typically receives guidelines and targets for monetary policy from the government, which are established based on the country's economic needs and objectives. Additionally, the central bank often acts as an economic advisor to the government, providing information and analysis on the economic situation and future prospects. The central bank of a country maintains relationships with other central banks around the world. This international cooperation is critical for global financial stability and the coordination of monetary policies. Central banks exchange information, discuss economic trends, and share best practices to improve the effectiveness of their actions. Central banks also play a significant role in the global economy. Their decisions on monetary policy and financial supervision can have impacts on international markets, exchange rates, and capital flows between countries. Therefore, responsible and coordinated actions by central banks are essential for the stability and sustainable growth of the global economy. Challenges and current debates. The central bank faces several challenges and debates in the context of the current economy. One of the main challenges is the digitalization of the economy and the impact of technological innovations on the financial system. The emergence of cryptocurrencies, for example, has generated discussions about their regulation and their potential to alter the way financial transactions are conducted. In this regard, the central bank needs to closely monitor these trends and assess the best ways to deal with them. This involves analyzing the risks and benefits of emerging technologies, evaluating the security and stability of the financial system in the face of these changes, and seeking appropriate regulatory mechanisms. Another important debate is the pursuit of greater financial inclusion and the reduction of inequalities through access to financial services. The central bank can play an active role in promoting financial inclusion by establishing regulations that facilitate access to banking services and by fostering initiatives for digital inclusion.